Hello everyone, I'm Arnaud Salomon, coming from Switzerland to present you a very ambitious project because we are actually creating a completely new type of bank in Switzerland. This bank is based on three pillars. I'll have to do it fast, or I'm going to be very high level, so I'm sorry for that. But the bank is based on three pillars, and they're kind of fundamental, and I would say even philosophical pillars. The first one is full reserve. Second one is marketplace, and third one is tokenized. So let me explain quickly. Full reserve, I guess most of you understand. It means that we will never ever use the money you deposit with us to loan it out to someone else. We will never ever use the money you deposit with us to gamble on the market to make profit for ourselves. So it means we will keep a very simple balance sheet, super safe. We will never have risk. We will never have market risk on our balance sheet. We will never risk your money. So we want to be the bank that will have zero risk in the future. We want to be future-proof. So of course, as an institution, if we refuse this privilege to make on-balance sheet loans, which is pretty much 90% of the revenue of usual commercial banks, how do we make money? Well, that's my second point. Marketplace. We want to basically offer every single banking product and services in the form of marketplace. And if you understand that, it's very similar to what you see with Uber, Airbnb, etc. This collaborative economy. At the end of the day, you as a customer, you want to have the best product at the best price. And on the marketplace, that's exactly that. So let me give you two examples to illustrate that. Currency exchange. Currency exchange today, you don't know. Let's say tomorrow you're going to make a transfer to the UK, you send £1,000, you have no clue how much euros you're going to pay for these transfers up until the wire is gone. And then of course it's not transparent, of course the real fees is embedded in the price at which they sold you the currency, etc., etc. On our case, what we do is that we organize a simple marketplace for people to exchange opposite needs. So it looks like a very traditional order book that you can find on any Bitcoin exchange, but here it's for all the fiat currencies that you can find on the planet. And of course, on day one, we have an issue. We have the chicken and egg problem, because if we have not enough customers, then how do we make sure that we have enough liquidity to match all these things together? So we built a robot that is basically bringing a bid and an ask price and re-executing back-to-back every time it gets matched with brokers and banks. That means that today we're already able to offer you currency exchange at a maximum of 0.25% margin, and that's it. And that's the worst case scenario. Best case scenario, you create your own deal and it's free, and you can even make money out of it. And that's really the idea. You have two types of orders. You can either create a proposition to exchange money and wait to be matched, and because you're proactive, it's free for you. Or you can basically match the best available current offer on the marketplace. Every currency pair, right? So euro, dollar, euro, Swiss franc, etc., etc. So of course that comes with the very basic payment systems. Yeah, we should start with payment systems. So we offer you 30 different IBANs when you sign up with us. Yeah, 30 different IBANs in 30 different currencies. We format them because we don't understand why they should be random numbers. So we take the three last digits to input EUR if it's a Euro IBAN, CHF if it's a Swiss franc IBAN, GBP if it's a pound IBAN, etc., etc., so that you can never get mistaken anymore. And of course, we give you a master one, where basically with the single IBAN you can collect any currency and it will be allocated to the right sub IBAN. Of course, you have, like Revolut, a single card. We have the remote host authorization. That means that we can debit the pound account when you're in London, the Euro account when you're in Paris, and of course the Swiss franc account when you're in Geneva. And of course, if you're in Geneva and you do not have Swiss franc, well, the currency exchange is triggered on our marketplace, and of course not through Visa. And here we're talking about 40 times cheaper, not 40%, 40 times cheaper than what you would get otherwise. So this is for the payment use case. But now one of the crucial aspects of banks, because here we're going to replicate this concept of marketplaces for pretty much each and every banking product and services again. But let me give you another example which I believe is crucial, because this is the very core business of banks, loan. If you look at it on your own perspective as a customer, the only thing that you care is that you get the best deal and all your criteria are matched. You don't care if it's provided by BNP Paribas, UBS, or even Lending Club. The only thing that matters to you is that all your criteria are respected and you get the best deal out of it. And that's exactly a marketplace. We fetch those information for you, we present it in the marketplace way. That means that everything that comes on top is actually the best deal. But again, because it's an open marketplace, if you're still unhappy with what you've been proposed, even though it's the best you can find on the market, you can create your own deal and let the crowd subscribe into it. And that, if you look at it, looks very much like Lending Club or any crowd lending platform. And if you basically here, the idea is that people are happy with it in general. When you invest in a crowd lending platform, you're happy because, first of all, you intend to invest in projects or people you believe in. You get, of course, a better yield you would get in the bank otherwise. But there is a big drawback. And this big drawback is that you're locked in your investment up until the deal matures. And that leads me to the third aspect of this bank, tokenized. Because we have here a very bold ambition, and it's not an ambition anymore, it's a reality, to tokenize the entire balance sheet of the bank. Of course, if you look at it, from the balance sheet perspective of the bank, liability means the deposit of the clients. It means euro, it means dollars, it means pound, it means Swiss franc. And of course, we're going to bring them on chain as ERC20 tokens, issued on both RSK and Ethereum. You would have the option to choose. And you would have fiat currencies on blockchain that will be able to move, just like Tether. And of course, here we have a slight compliance problem, because we are, as a bank, the custodian of the real money, and what we issue on chain is just a representation of it. And because we, as a bank, are the custodian, that means that we're responsible for it. We're responsible for this money not being in the hand of bin Laden or ISIS or any terrorist or whatever. Yeah. So we have added a compliance layer on top of the Ethereum network through our smart contracts. That means that basically we do two simple things there. We ensure that people can transact within a set of whitelists for the tokenized fiat, and that you respect certain thresholds of limits that have been imposed to you during the KYC process. But that is one aspect. That is something that most people want to do, and that is only the liability side of the balance sheet. Now we want to go one step further and actually tokenize the asset side of it. Because if you look at it, banking assets, they are mostly contracts. 99% of banking assets are contracts. So what we do is that we take those contracts, we hash them, and we attach them to smart contracts, simple version of those contracts. So what's the point, you would tell me? Let's get back the example of loan. Loan is actually a contractual relationship you have with your bank. Every month you pay them back the loan, part of the loan you have made with them. And that is an asset for the bank, simply because it yields for them. But this asset for the bank is not liquid. Because now they have an asset, yes, but if they want to sell it to another bank, yeah, let's say you have a contractual relationship with UBS to pay them back every month, and UBS wants to sell that to Credit Suisse, well, they can, but it's going to be costly because they have to do the circle, simply because every month you keep on paying them back. If we replace that with smart contracts, the advantage is clear. Now you're not paying back an IBAN, but you're paying back an address, yeah, even with tokenized fiat. And what happens here is that the ownership is now managed by the smart contract itself. That means that on day one it can be UBS. On day two it can be Credit Suisse. You don't care, you're still paying back the same address. But because it's a token, it's divisible, and therefore it's also possible for the crowd to collectively own it. And this is where we can enter a whole new set of possibilities for the bank to bring new type of asset, those assets that used to be traded only by bankers or investment bankers, where the minimum ticker was 1 million. Now you can bring it in the form of marketplace, tokenized, and have access to the crowd. And when you think about it, you can tokenize pretty much everything that the bank has in custody and bring it in a fraction to the crowd. If you think about SMEs, the way they finance themselves today, they do not have access, because they're not the blue chips, they're not the ones that can actually do IPO and raise tons of money. So they're all local. They have no access to that. The only way for them to get finance is through loan from their bank. And they are very in an inferior position for that. Now here the idea is really that you have your own pizzeria. Yeah? You love your pizzeria downstairs. You believe that this pizzeria is the best of Paris. And the guy wants to open a new one in another place of Paris. You're sure it will work, so you will invest, and you know this investment opportunities because in your e-banking ecosystem, you can select pretty much the circle of area that you're interested to receive deals from. And you can really think about many things really far beyond that. And any product that is traded on the Swiss stock exchange or on the French stock exchange can be also brought and tokenized and available for the crowd to be traded and owned. Let me just go. This is important to understand. This is our IT vision. And it's crucial to understand it, to understand why we do it. So basically, it all starts with the smart contracts. The smart contracts is the base of the entire bank. And then on top, we build bricks, yeah, to add new services. So of course, the traditional payment systems, the currency exchange. We have negotiated the remote host authorization with MasterCard. That means that we do the authorization ourselves, not them. That means that we can, of course, debit the pound account when you are in London, the euro account when you are in Paris, etc., etc. And of course, this ecosystem is open for any tech person in this world to come and build new fintech services without having to deal with the fin part of fintech. Simply because the way we have made our IT is from a simple observation of what's the problem today within banks. They run huge, big monolith system that is called the core banking system. And that's when it becomes obsolete. There are two options. Either they change it or they use patch on top of it. Yeah? That's what they do today. Simply because today, changing a core banking system for a running bank, it's like driving at 130 on the highway and you need to change the wheel. It's complex. Of course, logistically you can do it, but it's super complex and costly. It's way easier to stop on the side, change the wheel, and go again, right? So based on this observation, the way we build it is by creating a set of microservices that communicate to each other. Each of those microservices is basically running in its own technology. It's running in the best technology it needs. So for example, the order book needs to be super fast. So it will run in one technology. The persistency of accounts needs persistency, yeah? So it will run in another technology, etc., etc. If one of those microservices become obsolete, we just replace the microservice and not the entire monolith. And all those services are basically communicating to each other. And at the center, there is a rule engine. And this is the core, the heartbeat of our bank. This rule engine makes sure that everything happens within the rule, within a set of rules that has been defined with FINMA, the regulator in Switzerland, but also specifically to each and every individual that we have onboarded, because of course the plumber will not have the same limit as the super high net worth individual. And that allows us to basically have an open API so that any tech person can plug their own service into it and build new fintech services. So on-chain, it looks like this. So in the middle, you have the bank, the centralized bank, because again, it's a bank. So we need to run it in a very centralized way. On the left, this is let's say, the legacy payment systems. Yeah. So how does that work? Every time you deposit €1,000 with us, we issue €1,000 on-chain. And this €1,000 is in a wallet that the banks control.
That's a private chain.
And that's the Ethereum public blockchain, actually. Yeah. And so these €1,000 are in a wallet that the banks control. So basically, you know in real time the entire liability of the bank, yes, but you don't know who has what, because it's a wallet owned by the bank. That means that we are still respecting the Swiss banking secrecy. Yeah? But at least you will know in real time the balance sheet of the bank. Now, when you're about to make a payment out, two options. You pay the legacy world, well, simple. We redeem the coin on chain. We send the money to the corresponding bank that will deliver to your beneficiary. But again, you can choose, instead of paying to an IBAN, to pay to an Ethereum address. And that's what happened, simple. The token will simply move from a wallet we control to a wallet you control or your counterparty control. Again, here there is a compliance issue because depending on the type of asset you're issuing on chain, you have to comply with certain rules, and especially when it comes to fiat currency. Fiat currency is like the most trusted of all. That means that we have to make sure that each and every participant within the Ethereum blockchain needs to whitelist first a wallet and attach it to an ID. And once that is done, they can transact easily. Yeah? Now, if you look at other type of assets, we can do the opposite way. We can say transferability is free, completely free. but we will remove the privilege. And if you look at it, it can be for shares. When you tokenize shares, shares are basically what? Dividend and voting rights. Now, if you only have a token without those privilege, it's a token that can move freely, but again, it's not really a share. So that means that we can have different type of rules in order to restrict the KYC, the transferability, or to let it completely freely transferable so that you can have it, but it's kind of worse because you don't have the benefits around it. You need to do the KYC first and then you can get rented the benefits. Yeah? So that's really the vision of the bank being the custodian agent for your money, your assets, and organizing facilitators, marketplaces for you to trade and pay and get paid. As I said, as a bank, you can tokenize pretty much everything. There is no limit, even art. I mean, who has never ever wished to own a Picasso? But of course it's too costly for a single person to own, an average person to own it. Again, as a bank, you can own a Picasso, tokenize it, and let the crowd be able to own 1/1,000,000th of this Picasso. And again, because it's a token, you can add even a yielding component into it because a Picasso has a yield. As a bank, you will put it in a gallery, you will put it in some museums, and they will pay for it. And therefore, you're able to pay a yield to the token holders that owns these assets. So there is absolutely no limit to tokenization with the regard of the custodian bank, the centralized custodian bank that actually owns those real assets that has been issued on chain. And of course, I will go back to the question later. And of course, the burning question, yes, my friends, this is all legal. We're working since more than a year now with EY, and of course the FINMA, the regulator, to get regulated as a bank in Switzerland. And today, the feedback is absolutely amazing. So the way we did it is not by going to FINMA and say, look, this is what we do, please qualify us. No. We took the other step. We said, look, this is the ambition we have. We know it's tricky for you because we involve cryptocurrencies, because we even want to basically offer IBANs for BTC, IBANs ETH. Yeah? So not only limiting ourselves to fiat currencies. And of course, this creates issues for the regulator because if they look at it, they're like, oh my God, it bears some money laundering problems there. I mean, Bitcoins, it used to be to finance whatever, drugs and this online. So how do you make sure that you have a process for that? So because we know that this could delay our application for the banking license, we have split it into two. And we made it in the first version where we say, this is a bank on blockchain, this is not a crypto bank. So if you look at it, the blockchain aspect is the core banking system that you, the regulator, know how it works. And we can prove to you that we are on top of everything, and we can show and prove to you that Ben Laden will never own one of those assets on our network. So that shows them that actually we know how to deal with risk, we know how to deal with pretty much everything that has to do with banks, and we have a plan for the next step. And again, now we are educating the regulator to show them, okay, this is how you conduct an on-chain due diligence on the origin of the fund. This is how you make sure that this fund has never gone through the darknet. And of course, you have a higher rejection rate from assets like Bitcoin when they come to banks because it's way harder to prove. And some people are super honest, but because they were too libertarians at some point, they all bought everything in cash and they did it with local Bitcoins, etc. It makes super difficult to actually prove the story that the client is saying. So you have a higher rejection rate, but at least you can still onboard some of those clients. The easy one, yeah, the one that has participated in the Ethereum ICO at some point in his life. He did put 10K in it. He is now super rich. It's fine. You can easily prove it. He has never moved the coin, so you can read the blockchain and document and onboard the client with money saying it's clean. And this is what now we're documenting with the regulator to show that it's possible to actually accept crypto deposit within a Swiss institution. And I think we won't have time for that, but this was an example as for the bank, just quickly, how you manage, how smart contracts can be a game changer for banks when you look at how much money they spend in back office, middle office, reporting, etc., etc. If you look at it, it's super easy. Today, a trader from bank A that is trading with bank B, OTC, they call each other, they trade on screen, whatever. At the end of the day, because each bank has its own ledger, Every party goes into its own system and enters it. At the end of the day, Bank A sends a confirmation to Bank B. Bank B does the same. The back office looks at the two, internal versus what they've received from the counterparty. They match, or they have to reconcile if it doesn't match. Most of the time, they have to reconcile. And then what they do is all these processes is super costly in terms of back office, middle office. If you look at it, a trader costs 1 million per seat, just the seat. Before he even makes money, he has to pay back all the back office, middle office reporting. Now, if you replace all that with a simple smart contract, because again, traders are trading contracts, huh? So if we replace this with a smart contracts issued on chain, what happens is that trades and settlements are only separated by a few seconds, not days, and that changed the whole game. Reporting, no more dispute. It's on chain, it's live. There is no like overnight batch running and generating reports for you. It's there, and it's undisputable because at the end of the day, both parties are reading the same ledger. We estimated that you can actually reduce 50% of most of the investment banks' costs today simply by moving trading to smart contracts. And bad use cases, of course, Swift has announced that they want to use blockchain. What do they say? It's a bad use case because simply it doesn't mean anything. Swift is a centralized messaging party. Why would they want to use blockchain to make themselves irrelevant? Of course not. So they will make a private blockchain, and for them it will be more costly to maintain than a central database with an API, and at the end of the day they will not allow participants to actually do something over it. So that's bullshit. Thank you.
So we still have time for a few questions. And by the way, since we started the meetup, Ephraim, we got 10%, so I think we're doing a good job here.
Hi, thank you for the speech. Very interesting. I don't know SMEX. What is it? It's the bank or it's a provider for?
No, let me tell you, this is an interesting story. So SMEX is basically historically the company we have in Switzerland that is building tech for banks. And we were specialized like 3 years ago in building blockchain and fintech product for banks actually. And so this is the mother company of this project. And the story is quite cool because what we used to say is that as opposed to banks, we put tech on top. This is the mother company, yeah, and not in the basement.
So my question was, the trust in the fiat currency is based on debt, which is collaterals in central bank.
Yes.
And the basic of the debt is that the money is illiquid. In fact, money is liquid, but the debt behind is illiquid. As you said, the ticker is 1 million. What happens if tomorrow you start to build CDOs on Ethereum and you have liquidity on this? What will happen on a huge scale? How do you think about it?
Well, nothing special will happen. I mean, it will allow people to own those things. And again, you don't need necessarily to create CDOs to create complex product. Of course, it's interesting because by packaging the several loans together, you average out the risk, but also it gives the opportunity for people to directly own it without intermediary. That means that the yield will mostly go back to their pocket instead of the middleman.
If you remove the liquidity of a debt, you remove the value of the debt itself, which means the money behind.
Well, this is in a very philosophical way, yes. But if you look at it in the way we do it, there is no specific problematic because of the scale we are. We're not gonna be the only bank in the world. We're gonna be one amongst many. So again, today, if you look at it, most people in Switzerland still believe that UBS is the safest bank on the planet, simply because it's huge. We know it's not true. We know they bear enormous risk on their balance sheets. But again, this is the perception of people. So we know that at some point, our bank is going to be for, first of all, some ambassadors, some people from the blockchain community, because this is very powerful for them. But at the same time, we want to expand and have normal people because of the simplicity of usage, because of the payment system, because of being super transparent and cheaper.
What are you missing before you can launch a project? Actually, technically, why are you here? Why are you doing this
Today, the only thing we are working extremely hard that we are missing is actually the banking license. As I said, we've been working on it since 1 year. We have EY as a partner, and we believe now we have kind of answered pretty much all the questions of FINMA. We've made those 2 scenarios that puts them in a very comfortable situation to look at us as a neobank and not as a crypto bank. And therefore they can really look at the model of N26 or whatever, and they can say, okay, so we need also in Switzerland a neobank, so that makes sense, and the crypto aspect is something we will discuss next year or probably the other. So that's pretty much the roadmap we have made with them, and for us we don't see any blocker anymore.
During your presentation, you fluidly moved from owning to controlling back and forth all the time. For me, there's a conceptual gap here that I don't really understand. How do you...
The bank owns it all the time. So this is pretty much the... so a bank in general is a custodian. So whenever today you deposit money at the bank, actually what you have is not your money anymore, it's their money. Yeah? It's a loan actually that you are doing. It's an opposite loan. You are doing a loan to the bank.
So
that's why also they pay you back interest.
You're a centralized database of who has what.
Yes.
Right.
Yes.
Okay.
Yes. But the ledger for that is the blockchain.
For your lending model that you were talking about, the peer-to-peer lending, what happens in the case of a default? Would the person who lends have to bear the brunt of it, or would Pelerin guarantee their money that they're lending?
No. Actually, again, Pelerin never takes risk. So Pelerin cannot guarantee any loan whatsoever. So the way it works today is that in the roadmap of execution, of course, we're not going to offer everything at once. Yeah? So we will go step by step to release things. So the very first thing is to do collateralized loan. That means that those loans have a real asset collateralized. It can be, for example, for real estate, but it can also be, if you look at it, because we intend also to offer you a Bitcoin deposit and Bitcoin IBANs, is to use this Bitcoin as a collateral for a fiat loan. Yeah. So basically, you put them in a deep vault with us, and you can pledge those coins and get a fiat loan, because you don't want to sell those coins to get the money, because you still want to be exposed to the market, but at the same time, you need the money to basically buy something. So you can pledge them, have a loan. And because it's collateralized, that means that there is no risk on this loan. If you don't pay back, it will be liquidated. Of course, we don't offer you 100% collateral on it. And for uncollateralized loans, people are taking risk. So whenever you organize a marketplace where you have assets that you can buy and sell, those assets will all have risk. And you will have, let's say, a picture where you will see, okay, so this asset represents this and that. This is all the specification. You will have a risk assessment with a grade that you will see, and it's up to you to decide what type of risk you're willing to take. And again, here, this is done for the very proactive users that will do the cherry pick. But those that are the passive ones, those that do not want to actually, they still want to have a yield, yeah, because they want to have a yield over the money, but they don't want to do this cherry pick. They don't want to take the risk of everything. They will be able to use something that we are creating on the side, which is the fund. So we have a fund internally within the bank, so that just like you have a saving account, your saving account is basically I'm giving the right for the bank to do everything they want with the money, generate some revenue, take part themselves, and give me some. Yeah. So here with the fund, it's pretty much the same idea. So instead of calling it a saving account, you call it a fund, and you can drag drop money there. You have a yield over it, and we take care of everything, the cherry pick, the risk, and everything, and you just get the yield back.
Okay, so
but of course, you will never get as much money as you would get if you are the proactive user cherry picking everything. Yeah.
Okay, so you have a metric, so you have a grade for everyone who wants to borrow money, but then if a lender is stupid and someone defaults,
yes,
they give someone like an F grade, it's their fault.
Yes, exactly. And again, here on our side,